Welcome to this edition of All Things Economic. I'm Gil Matthew, Executive Director of the Nevada County Economic Resource Council. And today we take a quizzical look at supply and demand. Suppose you are the Acme Cookie Company and the demand for your wonderful cookies increases. What do? Sure, buy more flour, etc., make more cookies. But suppose we are talking about gold. Can we just bake up some more gold? No. Let's start with the big picture. Gold has always had a special place in our collective economic imagination, a symbol of wealth, a store of value, and a hedge in uncertain times. As one analyst put it, large gold price fluctuations mainly reflect its role as a financial asset rather than simply as a mined commodity. In January of 2024, gold was approximately $2,035 an ounce. The price steadily increased until October 2025. The price was approximately $4,087 per ounce. So what's driving that move? The story involves both demand side and supply side forces. But the supply side is especially interesting because one might assume if supply increases, prices should moderate. Yet that hasn't really happened. Let's ask why. According to the World Gold Council, total gold supply in 2024 rose by about 1% over the previous year. Within that, mine production was slightly up, and the recycled gold supply by about 11%. You see, for real total increases in the gold supply, mining only accounts for about 73% of the increase, while recycled gold, that is your grandmother's gold locket and other gold items, account for 26%, and then a very small, about 1%, is from existing holdings in central banks that is released to the market. So, say production is growing, but only modestly. For instance, global mined gold production was about 110 million troy ounces in 2023, which itself was the highest since 2018. So supply is not surging, it's creeping up at best. Plus, the World Gold Council notes some of the easy gains are behind us. The mining industry is hitting headwinds, lower grades, rising costs, fewer new large discoveries. Extracting more gold is getting harder, so even as prices go up, supply can't simply explode. Let's turn to the demand side, because that is what really pushes gold prices up. Gold is increasingly treated not just as jewelry or an industrial metal, but as a strategic asset. When inflation rises, when currencies get shaky, when economic or global political risks loom, investors pile onto gold. As Tufts University wrote, the price of gold has jumped. This leap cannot be explained by the sudden increase in the demand for gold as jewelry or for its use as industrial production. Rather, it reflects the shifting demand for the yellow metal as a financial asset. When real interest rates, that is, interest rates minus inflation, are low or negative, holding gold becomes more attractive. And if the US dollar weakens, gold, as measured in dollars, becomes cheaper for foreign buyers, boosting global demand. Several central banks around the world have been increasing their gold reserves as a diversification away from the dollar and traditional reserve assets. These purchases absorb supply permanently and reduce the amount of gold available for other buyers. Gold-backed exchange trade funds, ETFs, and other forms of investment gold have been increasing inflows in recent years, adding pressure to the market. For example, in Q1 of 2025, investment demand more than doubled year on year. Hence, the demand is rising for financial and strategic reasons, and supply is only creeping higher. That combination is exactly what drives prices upward. Now, why has the rise in gold been so quick, and what might it limit it? Because of the tightish supplies and the stronger demand from multiple fronts, gold prices have been propelled upwards faster than any other previous cycle. The convergence of inflation concerns, weaker real yields, geopolitical uncertainty, broad institutional interest, and central bank buying are powerful multipliers. What factors could limit growth? For sure, global economic stabilization, reducing safe haven demand, stronger real interest rates, or a major increase in mine production, though that appears unlikely in the short term. Also, as gold prices rise, affordability for traditional buyers, that is, in jewelry markets, becomes an issue and could dampen demand. In conclusion, when supply is relatively flat or only slowly growing, any boost in demand or any big shift in investor behavior will push the price up sharply. That's the story on gold price today. And until next time, be well and thrive.